The magic of stock charts. All right, folks, Adam Savage here. Today we're diving into something explosive: stock charts. You might see them and think, whoa, complex squiggles, but trust me, they're not just random lines. These charts are like treasure maps. They can guide you through the wild world of the stock market. Learning to read them, that's like getting a superpower, a financial superpower. It's pretty cool, right? So why should you care about these charts? Imagine you're building something awesome. You need a blueprint, don't you? Stock charts are kind of like blueprints for investors. They show you the history of a stock's price. They tell you a story about how it has performed over time. This story can give you clues about where it might go next. It's not a crystal ball, mind you. Nothing in investing is guaranteed, but it's a powerful tool in your workshop. Think of it like this. You wouldn't drive a car without a dashboard, would you? Your dashboard tells you your speed, your fuel, if something's wrong. Stock charts are the dashboard for your investments. So grab your safety goggles, metaphorically speaking, and let's get charting. This is going to be an adventure in data. Okay, team, let's talk about the different flavors of stock charts. Just like ice cream, there isn't just one kind. Each type of chart shows you the stock's price information, but they do it in slightly different ways. The three main heroes we'll meet today are line charts, bar charts, and the ever-popular candlestick charts. First up, we have the line chart. This is the simplest of the bunch. Imagine connecting a series of dots. Each dot usually represents the closing price of a stock for a specific period, like a day, a week, or a month. You connect these dots and boom, you get a line. This line gives you a quick, clean overview of the price movement. Next, we have the bar chart. Each bar on this chart represents a single period, just like the dot in a line chart, but a bar tells you more. It shows the opening price, the highest price, the lowest price, and the closing price for that period. And finally, the star of the show for many traders, the candlestick chart. These are my personal favorite because they are so visual. All right, let's zoom in on those fascinating candlestick charts. Each little candlestick is like a mini episode in the grand drama of the stock market. To understand the story, you need to know the anatomy of a candle. Every candlestick has two main parts, the body and the wicks, sometimes called shadows. The body is the thick rectangular part of the candlestick. The body shows you the difference between the opening price and the closing price for that period. If the stock closed higher than it opened, the body is usually one color, often green or white. If the stock closed lower than it opened, the body is a different color, often red or black. The size of the body tells you how much the price moved between the open and the close. Then you have the wicks or shadows. These are the thin lines sticking out from the top and bottom of the body. The wick on top shows the highest price the stock reached. The wick on the bottom shows the lowest price the stock hit. The body tells you the open to close range. The wicks tell you the high to low range. Now that we know the basic anatomy of a candlestick, the body and the wicks, let's talk about color. Color is a super important visual cue in candlestick charts. It gives you an instant read on whether the price went up or down during that specific time period. Think of it like traffic lights for your stock analysis. Green means go, price went up, and red means stop, price went down. Typically, a green or white candlestick means the closing price was higher than the opening price. This is generally seen as a bullish sign for that period. Buyers were in control, they pushed the price up. The longer the green body, the stronger the buying pressure was. On the flip side, a red or black candlestick usually means the closing price was lower than the opening price. This is generally seen as a bearish sign. Sellers took charge, they dragged the price down. The longer the red body, the stronger the selling pressure. But it's not just about individual candles. The sequence of these colored candles, their sizes, and the lengths of their wicks all combine to form patterns. These patterns can give you clues about potential future price movements. Section 5, Seeing Shapes, the famous head and shoulders pattern. Okay, chart detectives, now we're getting into the really cool stuff, chart patterns. These are specific shapes that appear on stock charts formed by the price movements over time. The head and shoulders pattern is one of the most well-known and reliable reversal patterns out there. It often signals that an upward trend might be running out of steam and could be about to reverse downwards. So what does this head and shoulders pattern look like? Imagine a silhouette of a person. You have a left shoulder, then a higher peak, the head, and then a right shoulder that's roughly the same height as the left one. On a stock chart, these shoulders and head are peaks in the price. The price rallies to form the left shoulder, then dips a bit, then it rallies even higher to form the head, and dips again. Finally, it rallies one more time to form the right shoulder, but fails to reach the height of the head and then starts to fall. The key to this pattern is the neckline. When the price breaks down below this neckline after forming the right shoulder, that's often considered the confirmation signal. Section 6. Spotting reversals, double tops and double bottoms. Let's keep our pattern spotting goggles on. Besides the head and shoulders, there are other super useful reversal patterns. Two of the most common are the double top and the double bottom. As their name suggests, they involve the price hitting a certain level twice. These patterns can signal that a trend is about to change direction. A double top often warns that an uptrend might be ending, while a double bottom can suggest a downtrend is losing its mojo and might reverse upwards. First, let's dissect the double top. Imagine a stock price is climbing, climbing, climbing. It hits a peak, then pulls back a bit. Then it tries to rally again, but it runs out of steam at roughly the same level as the first peak. It fails to break through to new highs. This creates two distinct peaks at about the same price level, looking like the letter M. When the price then falls below the low point reached between the two tops, it's often a bearish signal. Now let's flip that dear for the double bottom. This pattern looks like the letter W. It usually appears after a stock has been in a downtrend. The price falls to a low, then bounces up. Then it falls again, but finds support at roughly the same level as the first low. When the price then breaks above the high point reached between the two bottoms, it's often seen as a bullish signal. These patterns are all about support and resistance levels. They represent a battle between buyers and sellers. Section 7, your detective. Kit moving averages explained. Alright, super sleuths. Patterns are cool, but sometimes we need other tools in our chart reading detective kit. Let's talk about indicators. One of the most popular and easy to understand indicators is the moving average, or MA. A moving average helps to smooth out the price data to show you the underlying trend more clearly. It filters out the day-to-day noise of price fluctuations. Think of it as drawing a nice, smooth curve through all those jagged price points. How does it work? Well, a moving average calculates the average price of a stock over a specific number of periods. For example, a 20-day moving average calculates the average closing price of the stock for the last 20 days. As each new day passes, the oldest day's price is dropped and the newest day's price is added to the calculation, so the average moves along with the price, hence the name moving average. You can have short-term moving averages like 10-day or 20-day, or long-term ones like 50-day, 100-day, or even 200-day. Section 8. Feeling the momentum, the relative strength index, or RSI. Let's add another awesome gadget to our technical toolkit, the Relative Strength Index, or RSI. This one is a momentum oscillator. It basically measures the speed and change of price movements. Think of it like a speedometer for the stock's price. Is the price rising or falling too quickly? The RSI can help you figure that out. It oscillates between 0 and 100, and it's usually plotted as a line graph below your main price chart. It's a fantastic tool for spotting overbought or oversold conditions. Traditionally, an RSI reading above 70 is considered overbought, while below 30 is considered oversold. Section 9. Chart your own adventure, making smarter investment choices. So, we've been on quite a journey, haven't we? We've looked at why charts matter. We've explored line charts, bar charts, and those super informative candlestick charts. We've learned to decode the messages in candlestick bodies, wicks, and colors. We've even hunted for famous patterns like the head and shoulders, double tops, and double bottoms. And we've added powerful tools like moving averages and the RSI to our analytical arsenal. The big question is, how does all this help you make better investment decisions? Well, understanding stock charts gives you an edge. It helps you move beyond just guessing or blindly following hot tips. You can now look at a stock's history, identify potential trends, spot warning signs, and find potential entry or exit points with more confidence. It's about making informed choices based on evidence, not just on a whim or a gut feeling. Remember, no chart pattern or indicator is a crystal ball. The stock market is complex and there are always risks involved. These tools don't guarantee profits, but they are fantastic for improving your odds and managing your risk. They help you understand the psychology of the market. Learning to read stock charts is an ongoing adventure. Go forth and chart your own path to potentially smarter investing. You got this!